Non-farm payroll revisions drop 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a downside surprise in July's payroll, helping make the case for the Fed to resume rate cuts. President Trump's tariffs kick in. The U.S. rates on goods across the world are set to rise to the highest level since the 1930s, and Amazon disappoints, while Apple surprises to the upside, wrapping up a blockbuster week for corporate results. Katie, you're watching.
Let's take a look at what those shares are doing, because Apple, it reported its fastest quarterly revenue growth in more than 3 years thanks to strong iPhone sales. It expects tariffs to add $1 billion in expenses this quarter. Amazon, for its part, it's trailing the sales growth of its cloud rivals as investors look for results from tens of billions of dollars in spending for AI products. You can see Apple shares actually up a little bit pre-market. Feels like we haven't seen that for a while. And then you take a look at Amazon really taking a beating right now, down about 7.7% in the pre-market.
I feel like I cared a lot more about that before 8:30 this morning. But we are focused on stocks, 30 minutes until the start of stock market trading. And Figma is one that was a massive success story yesterday. Or if you look at it a different way, they left so much money on the table, extending gains today after a 250% IPO pop yesterday, giving the company a market cap now above $50 billion. But Katie, it's really the jobs numbers that are front and center for this market.
Absolutely. 2 points. I feel like Figma CEO Dylan Field still made out okay. I think he's doing fine. Let's get back to that
Just
jobs
left $3
data,
billion
though.
on the table. No big deal.
Yeah, it's okay. He'll make it up. Anyway, this morning's jobs data came in much weaker than anticipated at 73,000, but it's the revisions that people are really focused on. Those downward revisions put the average rise in payrolls at just 35,000 over the last 3 months. Let's take a deep dive into the data with Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, we were talking off air about how there's always a margin of error when it comes to these figures, but boy, those revisions look really ugly.
The revisions are really ugly and really interesting. We had just 14,000 jobs created in June, according to the revised numbers from the BLS. It was 147,000. Took everybody by surprise when we first got those numbers. Private payrolls, only 3,000 in June, 83,000 in the month of July. Private payrolls were 74,000, half of what was created last month. So it is a major, major downward revision to the strength of the labor market, which was something that Jay Powell was touting at Wednesday's news conference. Now, the unemployment rate is just 2 basis points, less than 2 basis points, really, from 4.3%, almost a bigger jump there. We went to 4.2, which is a rounded number, 4.248. It does show you that we did have a lot of people losing jobs during the month, and we almost got a much bigger move, except for the fact that the labor force went down significantly again, 38,000 after 130,000 in the month of June. The only good news was that we saw wages rise a little bit more than anticipated, and that may be because if the supply isn't there, you got to pay up a little bit. The interesting number in terms of the labor force, though, 341,000 people who are foreign-born left the labor force. Not all of those were deported, obviously, but people staying home perhaps because they're afraid of getting arrested. The biggest changes that we saw were in the federal government, down 14,100, manufacturing off 11, administration and support 19,800. We have seen companies announcing that they were going to be losing some administration staff, sort of the middle managers in their companies as they cut back. Restaurants and bars lost 300. That's unusual. The only real gainer, the usual category of healthcare and social services, 73,000. And I want to turn back to something Chris Waller said in his dissent memo this morning as we leave this issue here. When labor markets turn, Waller said, they often turn fast. If we find ourselves needing to support the economy, waiting may unduly delay moving toward appropriate policy. So we are seeing that kind of reaction in the Fed funds futures market. And Waller may be taking I don't know if he'll be happy about it, but a victory lap in terms of what his forecast was.
Well, I'm very much looking forward to your interview with Beth Hammack, which is just coming up in just a few minutes. These numbers, I would say, are pretty shocking,
yeah,
right? I mean,
absolutely.
If you look at we have a function on the Bloomberg terminal, ECAN. You may be familiar with that. And if you look at that, you'll see a big green bar that just continues to grow over time, and that's healthcare jobs. And if you didn't have those healthcare jobs, you would have seen negative numbers in May, negative numbers in June, negative numbers, a loss of a massive amount of jobs in July. So it's only healthcare really that's keeping us up. And as you draw away these foreign-born workers, it's got to be upward pressure on wages.
And I think that would be unintuitive to a lot of people, that a lot of that strength was coming from healthcare. I will say you can see the surprise in markets right now when you take a look at the 2-year Treasury yield, now down about 18 basis points. People really recalibrating their Fed bets right now.
Yeah, absolutely. I mean, if you look across the curve, it's obviously focused on the front end, but massive drops in the 2-year, in the 5-year, even 10-year yields are down at 426. So pretty amazing moves. Michael McKee, thanks very much. You're going to be right back with Cleveland Fed President Beth Hammack. And I want to get to trade now because President Trump unveiled new tariffs across the world, some of those shocking as well. They won't take effect until after midnight on August 7th. So you have like a week to rush out and get a Swiss watch or Swiss chocolates because it's a 39% tariff on Switzerland. Joining us with more on this is Brendan Murray. He's our global trade czar. And Brendan, I guess some of these were unexpected, but we knew that tariffs globally would rise to about 15%, right?
Yeah, exactly. That's where we wound up. The big surprise, like you said, was Switzerland, and we just heard Jameson Greer interviewed saying that, yeah, they couldn't put that deal together, but the Swiss thought they really had it all together. But something happened where they couldn't get it over the line by the deadline today. There were some other surprises. India didn't get over the line either. They're getting hit with a 25% tariff. Taiwan was also close, but didn't get there. Theirs is 20%. So there are some key U.S. trading partners that are heading into the next, the foreseeable future, paying high tariffs if they can't get a negotiated deal. It sounded like Greer said, we're in the implementation phase of these tariffs now and out of the deal-making mode. So, it didn't sound like the door was that widely open for more talks or talks that they think can happen over the next coming days before that August 7th deadline.
All right, Brendan, great reporting. I know it's been a very busy week. That is Bloomberg's Brendan Murray. So taken together, if these are implemented as announced, as our graphic showed, the U.S. TAVR rate on average would be 15.2%. For those keeping track at home, it was 2.3% in 2024 before Trump took office. There's a lot to get to this morning, including earnings. Let's talk about Apple posting strong iPhone sales and a solid outlook, but it expects a $1 billion hit this quarter from tariffs. Amazon, meanwhile, is plunging as profit and cloud growth estimates fell short of expectations. Bloomberg Tech co-host Caroline Hyde joins us now with the details. I feel like we should talk about Amazon. I mean, it's nice to actually see Apple in the green this morning, but Amazon, what a wipeout. A lot of disappointment here, especially when it comes to cloud.
And to be fair to Amazon, it met expectations from the street and actually exceeded them on the fiscal quarter that they reported. And indeed, the forecast was looking good, but its operating profit was the weak point, the amount they have to spend. And as you say, the cloud growth was 17%, exactly what the market thought they'd see. When you compare it to 39% growth over at Microsoft's Azure, when you're thinking about 32% growth over at Google's cloud, why is the juggernaut with all the market share just seeing such a lower pace of growth in the cloud area? Why is the capital expenditure not reaping the rewards that we saw at the rivals? I think that's the anxiety here.
Well, they're being graded on the curve, then they're not doing well, right? Because everybody else is doing so much better. They expect operating profit, I think, of up to $20.5 billion in this quarter. And the street's estimate was only for like 19.2. So they could eclipse the estimate, but the street now, after we've seen Microsoft and Meta, wants to see Amazon do a lot better.
Yeah, I think they just wanted perfection. And with that operating profit, going from 18.5 to $20.5 billion, that midpoint, well, I think it's 15.5 to 20.5, that midpoint is below where the market wanted to see it more broadly. Look, Andy Jassy is quite often a more cautious kind of a guy. He's also willing to invest and say profit tomorrow, profit the next year, but not right now because I need to invest in my business. For them, it's an issue of infrastructure. They're saying we need more power. We need the issue of getting these things online when it comes to data centers. But we probably wanted to hear a little bit more about how they're managing to win over with the chips that they offer, how many more clients that they're managing to bring onto AWS. And at the moment, he didn't have that much fighting talk. He just said, look, this is a point in time. People don't want that to be the reflective. At the moment, the stock market is reflecting a point in time of the worry that they're slightly behind in this race when it comes to generative AI. Actually, I think one that is unfair on Amazon, given the strides that they've made with their own large language models and their own investment cases.
Well, to that point, if these losses hold Amazon on track to wipe out its year-to-date gains, let's talk briefly about Apple here, because Apple actually a surprise to the upside. Sentiment was so low on this stock, but they actually had some good news to talk about.
They did, and actually the shares are only popping about 2%, so I don't think it's like off to the races. There's still anxiety about tariffs, which both of you have articulated so well. They're saying that's going to be about $1 billion cost in the next quarter. They managed to come in less than their worst case scenario for the fiscal quarter just gone, $800 million of a cost. But we know that Tim Cook and his team are very good at supply chain. Where they're lacking is innovation. They did manage to get China back buying, whether it's the lower priced iPhones, whether or not it's also they're doing well in some of the other areas. The Mac sales in particular, they saw strength. The number one selling product really when it comes to computers in China. But what about the next iteration? They were woeful in time. The iPads was down. We saw generally the smartwatch and the home appliances not doing well. We need to get that foldable phone. We need to get the latest watch out the bag. We need more AirPods.
All right, we need more AirPods. Good to leave it there. Caroline Hyde, thanks so much for joining us. She co-hosts Bloomberg Tech. That kicks off at 11 a.m., so just an hour and 48 minutes from now. Coming up, Cleveland Fed President Beth Hammack discusses the state of the economy and pressure from the White House to lower interest rates as the jobs market kind of does it for her. Plus, we'll speak with Labor Secretary Lori Chavez-DeRemer after the huge payrolls miss and big downward revisions. This is Open Interest.
Well, we welcome our Bloomberg TV and radio audiences worldwide. I'm Michael McKee. Joining me now is Cleveland Fed President Beth Hammack. And Beth, if we only had something to talk about this morning.
I mean, it's been a really quiet morning.
It's been a quiet morning.
Yeah.
Were you gobsmacked by these numbers?
It was a disappointing report, to be sure. But when I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data. We look at the longer-term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully.
Well, the one thing that caught everybody's attention is the revisions. We went from 147 in June to just 14,000. And I want to point out the statement from Chris Waller earlier today on why he dissented. He had a line in there that said basically, when labor markets turn, they often turn fast. Does that suggest maybe that you made a mistake by not moving in July?
I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance. Again, today's report is just one report. We'll watch it carefully. We'll look to see if the dynamism in the labor market is picking up, because that's been something that we haven't really seen. If you have a job, you're able to keep your job. But if you don't have a job, it's harder to find one. But in aggregate, we're still seeing unemployment in that 4.2 range where it came out today. But it's been 4.1 to 4.3 for the entire year. We're seeing pressure on the inflation side of our mandate. That's where our miss has been bigger, and it's been lasting for longer. We haven't hit on inflation in 4.5 years. And when I'm out talking to people across the district, whether it's Wheeling, Toledo, Cincinnati, what I hear from people is that the pain of inflation is really biting. They're making very difficult choices. They're trading down from buying ground beef to buying hot dogs, the $400 emergency fund that they have, they're not able to stretch as far as they used to. And so we have to balance those two sides of our mandates when we think about setting correct policy. And we have to look at if we're missing, by how much and for how long do we expect those misses to last. And right now, we're missing by much more on the inflation side than we're missing on the employment side.
That was basically sort of the message that Chairman Powell gave on his Wednesday news conference. But we're looking at backward data always, of course. Looking forward, to get back to what you were saying about when you're talking to people, what are companies telling you about their plans? Let me put a two-part question. Does the poor job numbers that we got for the last 2 months now comport with what you had been told by companies? And what are they saying about what they're going to do about tariff price increases?
So what we've heard from businesses consistently is that uncertainty has been high for all of this year. They've had a difficult time making investments, executing on the plans that they had going into this year because they just didn't know where the economy was going to go. They didn't know how tariffs were going to impact their businesses. What we've heard consistently is that they fought really long and hard to get their labor force together, to train employees and make sure that they were really able to help produce, and that they're loath to let them go. But that can't last forever if demand ticks down. And so they're watching carefully to see if they're able to continue seeing that demand, if they need to pass on price increases to keep their margins where they need to be. And so I would anticipate that we could see some weakening. It's something we've been talking about and watching for, that we could see some weakening on the labor side of the picture. And if we see that, it would be something that we might want to respond to. Again, having to balance that against the inflation side, where we continue to really mess on that side of the mandate.
Well, what's the inflation outlook, basically? Are companies saying we can't absorb too much of this, or are they going to try to hold off as long as possible? Are Americans going to feel the tariffs sometime soon?
Yeah, I mean, my expectation, my forecast is that we will see the inflation numbers tick up. The $30 billion a month in tariff revenues is being paid by someone. It looks like it's more being paid by importers and consumers at this point. I think importers have borne a lot of that to this date, and it's likely that that will start to get pushed. We're hearing from the businesses we talk to that they can't absorb those costs anymore, and they will start pushing that out into prices to consumers. If you look at some of our forecasts, if you look at my forecast, I do expect that we're going to see inflation continue to tick up into the end of this year, and I expect that we'll see the labor market weaken into the end of this year. And again, how we need to manage that really depends on by how much and for how long we're going to miss on each side.
Well, let's talk about your forecast. Were you a 2-dot person or a 1-dot person for 2025?
There are other choices than that. There were 7 people at no dots. I don't usually disclose my dot, but part of my view has been that we see an economy that's operating right around full employment. We've been, reasonably close, not all the way where we need to be on the inflation side of our mandate, and the growth numbers continue to do well. So to me, I think that the economy is operating right around a neutral long-term rate. We're a little bit restrictive. I think I've said modestly restrictive, but I don't think we have much further to go to get to a neutral Fed funds rate.
I know that you're going to say 1 month's data are not determinative when I ask you this question, but I've got to ask because the markets are posing the question. We went from 40% chance of a rate move in September to over 70% after these numbers came out. Is September a realistic possibility now?
1 month's data is not determinative. I will in fact say that. But I enter every meeting with an open mind. I think, my job, and I think all of my colleagues around the table walk into every meeting with an open mind to make sure we're looking at the data. And we're going to get an awful lot more data between now and the September meeting. We'll get another jobs report. We'll get 2 inflation reports. And there'll be a lot more time to be out in the district talking with business leaders, talking with community leaders, understanding their experiences to try to put everything together. So I walk into every meeting with an open mind to make sure that we can support the American people and that we can have an economy that's working for everyone.
Well, obviously, the markets today are looking at the labor situation, and you were referencing the inflation situation. If inflation's going up, you can't cut rates. If the economy's collapsing, you have to cut rates. So how do you balance the two right now?
Yeah, this is a really tricky time for monetary policymakers. This is when both sides of our mandate could potentially be in conflict, and we'll really have to look at what is the size of the mess and for how long do we think that is going to persist. And so, again, it will take a lot of conversations with businesses, with community leaders. It'll take a lot of careful analysis of the data, and it makes sense that there can be disagreement at these particular moments. Because this is really the most challenging time for monetary policy.
Well, I've talked to a lot of your colleagues around the country, and basically they're saying companies are on hold. Now we've got the tariff numbers. Do you have any indication of how fast companies are going to make decisions about what they're going to do in terms of staffing, in terms of investment?
Companies have been making decisions all along. I think they've been delaying or postponing or scaling back from what I've heard. So we have a franchisee who was looking at building new stores, and they decided instead they were just going to renovate existing stores. And so they were kind of downsizing their plans, if you will. Hopefully with more clarity around tariffs, and hopefully the policies that we have are durable policies, because that's really important to the businesses that I talk to, that they have certainty in what the policies are going to be against which they're making decisions. So it's possible that we could see some more investment being spurred here, given more confidence in the overall picture.
The other issue that is hanging out there, of course, is Fed credibility and the pressure you're getting from Washington. Donald Trump tweeting this morning that if Chair Powell continues to refuse to lower interest rates, the board should assume control, leaving aside the fact that the board doesn't take, this is not a banana republic kind of situation. How does the board and the Open Market Committee feel about Chairman Powell?
I have the enormous respect for Chair Powell. I know him to be a person of incredibly high integrity, and I know he walks into every meeting and approaches every day, making sure he can do what's best for the American people, just like I and all my colleagues around the table do. And so I think each one of us goes into a meeting with an open mind. We have a really rich discussion. We learn from one another. We listen carefully, and people reading the exact same data can disagree. That's what makes markets, and it's no different for, economists or policymakers. But it's a good conversation. It's very collegial. It's very collaborative, and we make sure that we're doing what we think is in the best interest of the American public.
Now, I can't really say what the president is thinking, but he tries to give the impression that if only this meddlesome priest were taken care of, interest rates would go down. You'll be a voter next year. If you get a new chair appointed by the president who comes in and says, I want rates to go down, how will you vote?
I will look at where the data is. I will look at how the economy is performing, and I will approach that the same way that I've approached it all of this year and all of last year, which is to make sure that we're hitting as close as we can on both sides of our dual mandate of maximum employment and stable prices.
Do you worry that the Fed's credibility has been damaged by all of this in the public mind or in the business mind?
I've been really reassured by a number of business leaders and the Treasury Secretary who all talk about the importance of monetary policy. There is a large body of literature about how economies that have independent central banks have much better economic outcomes for their population than ones that don't have that level of independence. What you've seen across the globe is a bigger move towards independence, and so I'm encouraged that our leaders, our business leaders, and hopefully our government leaders recognize that that's critically important for the American people.
Beth Hammack, thank you very much for joining us.
Thanks
the
for having me,
president
Mike.
of the Cleveland Federal Reserve. We'll turn it back to you.
All right, our thanks to Bloomberg's Mike McKee for that fantastic interview. Let's take a look at what markets were doing while that interview was happening. You can see the S&P 500 now down by more than 1% pre-market. Big tech taking an even bigger leg lower, with the NASDAQ 100 off by about 1.4%. But honestly, most of the action this morning is in the bond market. As you can see, the short end of the yield curve really declining this morning. That 2-year yield down 19 basis points. The 10-year yield down 11 basis points. Let's bring all of these questions to BlackRock's Chief Investment Officer of Global Fixed Income, Rick Rieder, who joins us now. Rick, it's great to have you with us on such a big day. And with the benefit of hindsight, taking a look at the numbers that we got at 8:30, taking a look at the revisions, which are starkly lower than what many were expecting, do you think that the Fed should have cut rates on Wednesday?
I mean, I do. Listen, I think there's a couple things that are salient here. One, the housing market. I mean, look at what we got this week. And, there are parts of this economy that are not interest rate sensitive, and there are parts that are. The housing market is interest rate sensitive. We're seeing mortgage applications, housing starts, building permits at an literally all-time low in many of those metrics. So I think that's a big deal. Second, if you actually strip these numbers apart, and I think Mike McKee said this, if you look at what actually the 3-month moving average, healthcare has actually created on average 68,000 jobs. The total payroll is 35,000, meaning it's created 200% of the jobs, meaning you have a service economy. You think about it, is healthcare interest rate sensitive? It's demographically sensitive. So you don't really, I mean, you think the interest sensitive parts of the economy are under some pressure. Lower income, who are the borrowers in this economy, are having a tough time. So would I have cut? Yes, I would have cut. And I think, the tail risk is, by the way, I think the economy's in pretty good shape. And I think that's really fair. I think there's some impact from inflation and productivity that's going to pull it down with a little bit of an uptick for tariffs. The big picture, though, I think, is you can cut the rate. You can get 100 basis points off this interest rate and still be above where inflation is tracking if you look at where break-evens are pricing. So I would have, and I think they will in September.
Do you think they'll cut? Is there a chance, Rick, that they cut by 50 basis points in September? Because I realize it's just one report, but that's what it feels like they need to do this morning.
You stole my thunder. Yes. Yeah, I would. I mean, I think you got to I think you should get the rate down. And I think at the end of the day, are you going to stoke more inflation? By the way, tariffs are not exactly interest rate sensitive. I mean, you have this near-term jump on it. Would I get that rate down to something and then see where you are? Yes, I think that's a possibility. I don't think, I've heard people this morning say you could get an intra-meeting. I don't think you would get an intra-meeting. I don't think the economy requires that sort of intense movement. But could you do 50 to get, similar to what happened last year? Could you get that sort of movement? Yeah, I think so. And by the way, I think the economy can handle it. By the way, I'll throw one thing on consumption. High income is what's driven savers. Wealthy, higher income is what's driven a lot of consumption. And you think about higher interest rates, it actually augments their ability to spend. So this idea that you cut it, I just don't think it'll have a debilitating impact on the economy whatsoever, or on inflation, I should say. I don't think it'll have any debilitating impact.
And Rick, I do want to point out, I mean, we keep hearing that it's just one report. We can't make too much out of just one report, but you think about the revisions. I go back to the revisions, a really shocking revision when you consider the June numbers being revised down to $14,000, or not dollars, 1,000 jobs. And then you think about what it looks like over 3 months. It doesn't feel like it's just one report here, Rick.
So, man, I think Fed President Hammack is super smart. The smartest I've known him for a long time. One of the smartest people I've met. And I have a somewhat different view in that and by the way, comments about inflation, I thought were dead right. The thing I believe, though, is if you actually take the broad context of where labor is today, so you look at the JOLTS report, you see job hiring that's way down. But then you don't see layoffs come off that much. Sure. You basically have an economy or a hiring market that's pretty stagnant. Companies are sitting on their labor today. But gosh, if you look at the context, by the way, the reason why claims doesn't move up is because companies aren't really laying off. But if you look at the hiring numbers, gosh, they're pretty soft today. So again, It's not a bad economy. I just think, it's not a 1 month effect.
I just want to point out we're looking at the opening bells here on the New York Stock Exchange and the NASDAQ market site. You're going to see big drops in stocks at the open. Obviously, futures were down bigly, and you have yields coming down at the same time, which is pretty interesting. So it does look like investors are selling out of stocks after this jobs report and using that money to buy bonds because I guess the elementary explanation is they expect the Fed to cut rates just like Rick says they should have and will. And so you want to get in at these levels because the next levels will be lower.
A rotation trade underway. It's also the first trading day of August. We're coming off of 3 straight months of gains on the S&P 500. So a little bit of a drawdown to start August.
62.73.
Yeah.
Wow. In basically one fell swoop, actually a couple of days, we're down from over 6,400.
Yeah, it has been quite a consequential week. Also a consequential week on the earnings front. And let's talk a little bit about Apple because it reported its fastest quarterly revenue growth in more than 3 years, thanks to strong iPhone sales. It did say that it expects tariffs to add $1 billion in expenses this quarter. Maybe that's why you're seeing sort of a restrained reaction in the stock. Not a restrained reaction in Amazon because it's trailing the sales growth of its cloud rivals as investors really look for results from the tens of billions of dollars in spending for AI products. That has been sort of the existential question hanging over these big tech names. When are we going to see some ROI here? Amazon shares down about 6.7% at the opening bell, Matt.
Yeah, Amazon down, Nvidia down, Broadcom down, Meta down. So you're seeing a big drop. Alphabet down as well. Figma, on the other hand, is extending gains. It was up 250% yesterday and a huge pop on the first day of trading. The company now has a market cap of above $50 billion. And let me just put this question to Rick, because I know what you think about it, Katie. Rick, Figma goes out and sells stock at 33 bucks, I think a share it was. Now it's trading at 137. They raised like 1.2 billion, but they could have raised $4 billion. I know it's good to get $1.2 billion, but if you look at it like you could have had $4 billion, doesn't that make you a little bit mad?
You know, that's a hard question. I mean, I spent a bunch of time. I can't talk about individual companies. I did spend a bunch of time looking at this company. There's some amazing technology companies, this one included, coming to market that I just think we're going through this extraordinary innovation, technology, productivity. You look at companies like this that have the ability to change, how we do certain parts of software, et cetera. Listen, I'm blown away. I think I said on Wall Street Week last week, and I was in LA the week before visiting technology defense companies. The world, by the way, this is part of my thesis around productivity and innovation, and inflation is going to come down on the backside of it. But yeah, I think it's the most exciting time I've ever seen to invest, because you're seeing so many of these new technologies like this one that are game changing, I think.
All right, Rick, hang tight. We're coming back to you in a couple of minutes. That is BlackRock CIO of Global Fixed Income, Rick Rieder. But right now, we want to turn back to the labor market. The U.S. economy added just 73,000 jobs in July, below almost all estimates. And joining us now, I'm pleased to say, we have Labor Secretary Lori Chavez-DeRemer. Great to have you with us, Secretary. Let's just start with these numbers, because the figure that we got, that was below all estimates in the Bloomberg survey of economists. To start, what's your reaction?
Well, certainly we know they could have been better. But, we look at the positive, because we still have a net positive, almost 500,000 new jobs since the president took office. Where did we see some of these, gains? We saw them in healthcare. We're seeing them in construction. We are seeing the revisions, I know, is something to talk about. And they were unexpected, those revisions. But most of those, 62% of those, were in education and seasonal workforce. So, we sometimes see the numbers catch up to what's on the ground, but I can tell you why we're positive is because the president is delivering on these trade deals, these tariff deals, understanding new countries are moving forward and wanting to be at the table. And why does that matter to the American business owner? As you all know, I've been on my 50-state tour. I just returned from several states. A lot of these business owners had some uncertainty in understanding what was going to happen. But now that the One Big Beautiful Bill is done, I feel like the table has been set, and we're seeing those investments happen. So we've seen positive job growth for sure, and they've been for the American workforce. Native-born workers are taking the lead. All job gains have been native-born workers.
I mean, with all due respect, the positive job growth, the most positive months you saw were still what the Trump administration was calling the Biden economy, right? For the first few months when we saw those big numbers, that was the Biden economy. Now that the Trump policy is taking effect, you're seeing downward revisions of 258,000 over the last couple of months. Only 73,000 jobs added. And it looks like, not just to me, but to participants in this market, that today's weak payroll numbers are a direct result of the conscious policy to limit immigration. And I'm just wondering if that trade-off is delivering the kind of benefits you want to see to U.S.-born workers.
Well, I can tell you this. I've been a business owner for 20 years. When we make decisions, we look at all aspects, and there's certainly snapshots. But what has happened on the ground? The One Big Beautiful Bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, you know, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money, but they're concerned with borrowing that more money. So that's another leg of the stool that can be done. We should all be rowing in the same direction.
But is it the only leg of the stool that matters, Madam Secretary? Because we had a 3-month run rate adding 150,000 jobs. And now that those policies that this administration has put into effect are active, we're looking at a 3-month run rate of 37,000. So it's drastically fallen. And what it looks like is the policies that you're putting into place are reducing job growth.
Strong job growth has happened, 3.9% over the last year. Consumer confidence is up. Unemployment is holding steady. Again, almost 500,000 new jobs have been added since President Trump has leaned in. I can tell you this, it's not the only leg of the stool for interest rates, but it's one of the important legs right now, because as businesses now know that the table is set with the One Big Beautiful Bill, they know that they can have the write-offs for their businesses. They understand that they will have the skilled workforce. My job on the ground is to provide that workforce. They're asking me, and I'm asking them to invest in their workers, invest in their companies, invest in their businesses across the country to grow this economy, and that's what they're looking for now. They want those interest rates down, and you know, Jerome Powell should do that. The president has leaned in for a reason, and that's to keep those promises that he made. We're going to continue to see over time those numbers go up. But what we have seen, federal jobs have been down. That's what the president promised. We've seen local economy. We've seen 84% of the job growth has been in the private sector. Why? Because the president has said that he is investing in the American worker first. That's what we're all about. I want these workers trained. We're seeing it in AI. We're leaning in with our federal and state partners together to say, let us give you the workers that you need for market demands in your respective states.
Right.
I think that that's the focus that needs to be.
Well, Secretary, I want to talk about some specific industries here. One of the interesting stats out of this numbers report is that without healthcare, actually the last 3 months of payroll gains, it would have been negative in May, negative in June, and negative in July. And then you take a look at manufacturing, shedding another 11,000 jobs. You take a look at the 6 months change, shedding 28,000 jobs. What are the specific policies that the administration has and is putting in place to revive the manufacturing sector? Because so far it looks like it's continuing to shrink.
Well, I think that that's probably what we just talked about. Those trade deals are now coming online. Again, I was just in Japan last week with the Secretary of Treasury, and that trade deal came in. We see the European Union has come in. We're seeing other countries as well. It's that certainty that we have to give businesses that that is being done. And then as well that they're going to have the workforce. So what do we have to do? I'm working with the Department of Education. I am working to skill those that workforce. We're working with our community colleges, our technical schools. And businesses are investing in centers of excellence. They just need a quarter turn for those workers to be trained and ready to go. One of those ways is executive orders to work with our state partners in order to get them trained and really lean in and have them right there on the ground. So when you see the uncertainty or the numbers drop over time, it's a snapshot in time. It doesn't make a trend. We're seeing it over time. The president has this right. The American business owner is believing in what they see. And now with this One Big Beautiful Bill, and if interest rates drop, I think that you're going to see more and more investments. I really couldn't be more clear when I'm talking to these business owners on the ground. I've visited 20 states. They are all excited. They all understand their marching orders now, and that's to invest in the American worker, and we're going to continue to double down and do just that.
Well, it does look like we're going to see interest rates cut at the next meeting. At least the market is pricing that in, Madam Secretary, and we're looking at rates drop really across the curve. Today, the 10-year down around 4.25 is relatively low. With that backdrop and the tax policy of the One Big Beautiful Bill and the deregulation that this administration has promised, what kind of jobs growth do you expect us to get back to this year?
Well, I'm making the assumption that with all of those being in play, when I think about the deregulatory framework that the president also has asked us to do, the Department of Labor has just issued 63 deregulatory actions. In Trump administration 1, 30 deregulatory actions were done over the 4 years. We've already done 63 in the first 6 months. And we're going to be looking to our companies to weigh in on this, because what does the president want? modernization, streamlining, cost cutting. He wants to be an ally for the American workforce, not an adversary. And for far too long, the Department of Labor or any other agency has not said, we're going to be your partners. So we will continue to go around the country. We will continue to lean in on interest rates, on investments from companies, on the worker, because we want to keep more money in their pockets. And we're seeing that consumer confidence. Wage growth is up. So there's a lot of positive here. We'd like to see better numbers, but we're going to continue to double down so those numbers continue to grow.
All right, Secretary, have to leave it there. Really appreciate your time this morning. That is Labor Secretary Lori Chavez-DeRemer. Meanwhile, we're back now with BlackRock's Chief Investment Officer of Global Fixed Income, Rick Rieder. We've already talked about revisions, but I want to talk about them a little bit more. There's a great stat from our Bloomberg Terminal Top Live blog that if you account for the big downward revisions to the last 2 months, payrolls have risen by just 35,000 jobs on average over the last 3 months. That is the weakest pace of hiring since the onset of the pandemic in 2020. If you were just taking the numbers that we get at 8:30 on the first Friday of every month at face value, it's a totally different picture when you get the revisions a couple of months later. And with that in mind, Rick, I mean, how much faith do you have in these figures?
So there's a lot there. So first thing I would say, further comment earlier, 68,000 of the 35,000 is healthcare. Like that, it's just remarkable. Like you said, these numbers are softed. The one thing I will say, people say, my God, this economy is slowing dramatically. I'm sure people come out with recession talk again, which will be wrong. The one thing I will say is you have an economy that is in a little bit of just wait. Like, well, you're not seeing layoffs pick up. You're seeing the claims data in pretty good shape. So listen, part of why I think we should cut rates is there is a risk you do get stall speed in hiring. And because I think that inflation is temporary, and I think you'll see these productivity dynamics playing. But listen, I'm not really worried about the economy. But listen, I think the rate threshold today is not consistent with what I think it should be. I don't think being restrictive today is the right posture. One man's opinion.
I mean, we're spending 7% of our GDP in deficit, so it's unlikely that we go into a recession, right?
Yeah, I mean, there's a series of tailwinds to the economy. And by the way, looking at the numbers, there was disappointment on Amazon today. These numbers, I mean, you think about what we just saw this week, the CapEx, the AI, the cloud, the new company that you talked about, new companies that you talked about. The economy, the foundation under the economy is pretty darn solid. I'm not really worried about it. It's created, I did a presentation yesterday called Potholes versus Sinkholes. This is, by the way, this period of time, July is historically the weakest month for payrolls, and actually August is second. So, and the data tends to be weak during this period. People shouldn't overstate that, what it means broadly. So, you go through these periods, you'll get some potholes. The fact that volatility was priced so low over the last few days was pretty remarkable. I mean, the ability to actually put some insurance in the portfolio for this near-term softness was pretty profound over the last few days. But I'm not worked up about, gosh, we got a tough economy coming. Particularly when you see the numbers you're seeing on CapEx and R&D spend.
I want to go right there to CapEx and R&D spend to some extent. AI CapEx has been nutso, like just eye-popping numbers, 85 billion from Google, 70 billion from Facebook. Next year, they want to do 100 billion. Is that money going to really power the U.S. economy? Is that like when we built railroads and highways? Or is it something else, Rick?
Listen, I shouldn't overstate it, but I think that the amount of money that's going into more efficient technology, by the way, you think about what's going into space technology, you think about the power required to actually create this and what it means for different parts of the power infrastructure. Listen, the numbers, like you say, are staggeringly large. I went through it on this call yesterday. I went through the sheer numbers we're going to see and the acceleration of numbers you're going to see. What does it mean? And by the way, you can get into the discussion, is there some near-term inflation as he's put this money into the system? 100% possible. You hit the other side of the mountain when you see and by the way, I think we're seeing it today, some of the productivity enhancements. So the numbers are big, but they're not just the numbers you spoke to, but which are large. It's how do you think about compute, cloud, energy, et cetera. And I mean, listen, I think this is one of the most extraordinary technological evolutions, similar to telephony, similar to internet, similar to rail? I do.
Rick, we probably only have time for one more question. You've been so generous this morning. So I want to take a pretty dramatic left turn here and talk about the concept of privatizing Fannie Mae and Freddie Mac. There's been a lot of talk of that. Our reporting shows that President Trump met with some of the big bank CEOs this week to discuss that topic. You own a lot of mortgages when you take a look at BINC. That is the ETF that you manage. When you think about this possibility, are you concerned at all that it will be executed in a way that could cause MBS spreads to widen?
So a couple things. By the way, y'all have been kind enough to give me a break, so I've been trading in this market, which is which has been exciting to say the least. It's like an incredible trading environment. So am I worried about? No, I'm not. I think whatever happens to the GSEs, I'm pretty confident that people understand the preservation of a housing market that, quite frankly, today could use some commercial push. I think is but to maintain some form of implicit or true guarantee, I think people understand that has to continue, and so no, I'm not worried about it at all. It'd be interesting, the developments around what happens, how it happens, how they build capital over time, and what those entities look like in terms of other things at their disposal. But the one thing I'm definitely not concerned about is, gosh, the credit quality of our mortgage position, of our agency mortgage position. By the way, not concerned about our non-agency mortgage position either, given so many things around HPA, et cetera, in the housing market.
All right, Rick, we'll let you get back to trading in this market. Good luck out there. Have a great weekend. That is BlackRock's CIO of Global Fixed Income, Rick Rieder. Meanwhile, let's take stock of this stock market. We're about 17, 18 minutes into the session, and boy, it's an ugly one. You do have some gainers right now, some companies fighting to stay in the green, actually about 112 of them. Take a look at what's leading in this market. On a points basis, you have Eli Lilly punching up here, AbbVie as well. Some of these interesting names that normally aren't in this plum position, but you have a lot of tech weakness today, and that's why you see this mix-up here, because NVIDIA currently down 3.5%. That's taking almost 18 points off the S&P 500. Amazon, Broadcom, Meta, JP Morgan as well, really dragging this market down. The S&P 500 now off by 1.6%, a really ugly start to August. Let's take a look at the sector breakdown. It's going to be broadly similar. There is going to be a lot of red on the screen. This isn't typically a screen that we look at. This certainly isn't the sector screen, but trust me, there's a lot of red when it comes to that sector breakdown as well, Matt Miller.
All right, a lot to talk about in these markets on the stock level for fixed income, labor data. Coming up, we're going to talk more about AI spending. The question is it going to pay off? Are we going to see, as you rightly asked, Katie, a return on investment here? Because Mag 7 companies are spending hundreds and hundreds and hundreds of billions of dollars. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what stocks are doing after that big miss for the non-farm payrolls number. You can see the S&P 500 off 1.7% to 6231. So still at a relatively high level, but what a big drop. The NASDAQ down more than 2% right now. And you can see that we have rates coming down, the 10-year yield at 4.25. The problem is a lot of red on the screen here, including NVIDIA. NVIDIA is off 3.5% today. Amazon is down 7% after really disappointing with numbers out yesterday. And then Figma, it's up again 1.5%. That's nothing, though, Katie, like the 250% gain we saw yesterday when they just left billions of dollars on the table after their IPO.
Yes, but they did have a big, beautiful one-day pop, so maybe that's a consolation prize there. We'll continue to discuss that at length throughout the day, so don't go anywhere. Let's talk about the big tech earnings that we got yesterday, though. It wasn't all about Figma. Bloomberg Tech co-host Ed Ludlow joins us now. And Ed, I actually want to start with Apple, because Apple had a good report. It was a beat and a raised quarter, but you can see that the stock actually turned lower. Where is the caution still lurking?
Yeah, it's the questioning of whether there was or was not pull forward in the June quarter because of tariffs and whether that will continue, right? So absolutely beat handsomely across every metric in the June or fiscal third quarter gone. And the guide on growth, mid to high single digits percentage growth going into the September quarter was a pleasant surprise. But Apple was very granular on the issue of how tariffs impacted consumer behavior and purchases of iPhones in particular. It was all in the month of April. It was largely in the United States, and it contributed just 1 percentage point in the 10 points of growth that they saw in that period. And during the call, analysts asked time and time again about pull in or pull forward. And the market this morning has given up the game. Some notes out there and some questions about whether we accept that there wasn't this great pull forward or in as it was quantified by Tim Cook and Kevin Perek.
I want to ask about Amazon, Ed, because you know, they did better than had been anticipated, but so everyone else did so well that they didn't do. They didn't keep up with the crowd, so to speak.
Exactly right.
And, but how much of this is just a problem of Amazon's, you know, tap on, tap off spending? Over the last 25, 30 years, you know, they've shown an ability to ramp up when they want to.
Well, you asked the question earlier, when does it pay off or will it pay off? You know, both of those questions are relevant in Amazon's case. The market's trading lower on an operating income guide for the current period that's seen as weak or conservative. But AWS did grow in the period gone. This is all about AWS. Forget Amazon.com for the time being. Even though it makes up the majority of revenues, the majority of operating income is cloud, and that's the domain that AI is coming. AWS growth of 17% is nowhere near the growth that we saw from Azure, for example. And so there's a concern that it's not paying off, but the spending commitment is more cautious too.
All right, Ed, looking forward to your program because there's a lot to talk about. Bloomberg Tech's co-host Ed Ludlow there talking about Amazon and Apple earnings. We've had the M's, we've got the A's. NVIDIA takes like months and months, right?
Yeah. Sit tight on that one.
Next hour, economist Kathy Bostjancic joins us, as well as Craig Moffett from MoffettNathanson. We are 30 minutes into the trading day, looking at big losses in equities as investors rush to buy treasuries. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. We're waiting for some breaking news to cross the terminal. But while we wait for that, just marinating a little more on that weak economic data that is shoving people into the bond market. And there we are with that data. The U.S. ISM manufacturing data is hitting a 9-month low of 48, just under estimates. We're going to bring in our own Michael McKee to break down these numbers here, because more weakness in a sector that investors want to finally see some love.
And we saw job losses in manufacturing, according to the BLS this morning. The employment index for the ISM comes in at 43.4, down from 45. So if we'd had that data before, maybe people would have guessed it a worse number. New orders, 47.1. That goes up a little bit from 46.4, but of course it's still below the break-even line for expansion. The prices paid number improves a little bit. 64.8 from 69.7, but it's still a very high number. So inflation and weak hiring in the labor, in the manufacturing area. University of Michigan sentiment comes out almost unchanged from the preliminary number, 61.7 from 61.8. Current conditions, 68 from 66.8. People feeling better about things, but they, of course, had not seen the headlines about jobs. The expectations index, 57.7 from 58.6. Now, the one-year inflation number ticks up to 4.5% from 4.4. Not a major change considering we were over 4 for a while. 5 to 10-year, 3.4. That's down from 3.6. So Americans feeling a little bit better about their situations, even if the overall numbers aren't as good that we got today because perhaps people had not seen.
You know, and it's interesting. You would think that the bond market had already seen a lot of the move that it would have this morning off that weak data this morning, but you actually see an even bigger bid into the 2-year after this data as well, almost 24 basis points lower. So very significant at the short end, but across the curve, Matt.
Yeah, absolutely. We've seen investors rush to buy treasuries, and that's only increasing after that news. Mike, you had a great interview with Cleveland Fed President Beth Hammack, who didn't seem as worried about the labor market after revisions lopped off 258,000 jobs over the past couple of months.
Well, she was basically taking the tack that most economists take, that 1 month does not necessarily make a trend.
But this was many more than 1 month.
This was more than 1 month. She's not ruling out a rate cut, but she is also worried about inflation. Here's what she had to say about the labor market and the Fed's decision not to move.
It looks like a healthy labor market that's still well in balance, but with some, disappointing signs that we should watch very carefully. I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance.
And basically, she's saying that her concern is inflation's still going up. We had the PCE report yesterday that showed both core and headline inflation rising on a year-over-year basis. And if that's happening, she said, you have to be worried about inflation. And it was interesting because she said, we were just talking about what Americans are thinking. She said everywhere she travels in her district, people are telling her they see prices going up and they are not happy.
All right, Mike, thanks very much. Mike McKee there, international policy and economics correspondent. Last hour, we discussed the state of the economy with Labor Secretary Lori Chavez-DeRemer.
Strong job growth has happened, 3.9% over the last year. Consumer confidence is up. Unemployment is holding steady. Again, almost 500,000 new jobs have been added since President Trump has leaned in. I can tell you this, it's not the only leg of the stool for interest rates, but it's one of the important legs right now, because as businesses now know that the table is set with the One Big Beautiful Bill, they know that they can have the write-offs for their businesses. They understand that they will have the skilled workforce.
Nationwide Mutual Insurance Chief Economist Kathy Bostjancic joins us now. And Kathy, it looks to me like the labor market has deteriorated since President Trump came into office and started putting his policies into place. How do you see it?
Well, good morning, Matt. Happy to be with you. Well, I think we're seeing evidence that the labor market is losing steam here, and rather rapidly, I would say, over the last 3 months or so. We see private cyclical job growth is essentially flatlined. So that's private jobs, excluding healthcare and social assistance, has flatlined, and that shows that businesses are kind of in this wait and see mode. They've pulled in on hiring, even spending really outside of AI, and you're just seeing this kind of pause to try to assess the landscape. I do think once there's more clarity, going towards the end of this year into next year, things will loosen up in the labor market. Hiring we think, will resume. But I think for now, you're seeing a real soft patch in the labor market and in the broader economy, as kind of the uncertainty is still high and the adjustment to trade changes.
Kathy, I want to pull up what the bond market is doing right now, because yesterday you had a bond market that was betting on a 45% chance of a rate cut in September. That percentage now is almost 86%. So drastic moves here in market pricing. You have 2 rate cuts now priced in this year. You have Rick Rieder over at BlackRock saying you could even have a 50 basis point cut. How drastically do you think the Fed will start cutting this year?
It's a great question. It's always interesting to see the dynamics in the market change so quickly. Our call actually a few months ago was for the Fed to start the rate cuts with 50 basis points in September. So I have sympathy for that view. I do wonder if that's not the right call. But given the Fed has indicated they want to be more cautious, you just showed Beth Hammack from the Cleveland Fed. Chairman Powell's been more cautious. We scaled that back to 25 basis points in September, but then we have a total still of 75 by the end of the year. But I do think the Fed has waited. Now, I know there's this uncertainty on inflation, and would it be more persistent and feed into inflation expectations? But the problem is that the labor market is now cracking, and more noticeably, and employment's a coincident indicator. So if you've waited until you start to see employment really slow, that means the Fed's got to go quicker.
If you don't see the labor pool growing anymore. Is it possible that productivity makes up for that to increase GDP growth? I ask because it seems like AI will do just that. I heard Priya Misra this morning talking about how she thinks it's really helped not to take away jobs as much as it has to make those people with jobs more productive.
I think that's another great point. I think underlying the economy, there's this tremendous potential for productivity increase, and we're seeing signs of that. And I think the AI is going to play a role. It's going to be the driving force on that. It may even be lessening some of the employment in the early entrant portion of the labor market. But I think overall, I agree with you. It's more of an enhancement, not necessarily right now really replacing jobs. What I see is labor supply is shrinking to some degree. That's immigration, no doubt, restrictions there. But also it's because people who want a job, they're becoming too discouraged to look for one. And you've seen that uptrend over the last several months. And I think they're dropping out of the labor force. If you adjust for that and kept the labor force participation rate the same as in April, the unemployment rate would be 4.9, not 4.2.
One interesting aspect of today is just how much you're seeing yields plummet across the curve, but the stock market is reading bad news as bad news. It used to be the case where a market was looking for rate cuts to fuel the next leg. Is that rhetoric now over?
So I think that right now, I think the equity market is a bit shocked by the weakness in the labor market, right? We just heard from Chairman Powell, labor market was in good shape, and I think that was the working view. Now we're seeing it is weaker, and then there's this concern the Fed's behind the curve, and maybe in a very large way, right? So I think eventually lower rates help the equity market. I also think clarity on the trade front, the tariff front, once we get past this adjustment, could be supportive. But I think right now, the equity market's got to be looking at growth probably in the second half of the year, which we thought is going to be on the soft side, probably below 1%.
All right, Kathy, great to get your take on this. Nationwide Mutual Insurance Chief Economist Kathy Bostjancic talking to us about this market, these labor numbers, this economy. It's pretty shocking to see those yields fall so drastically.
Yeah, and the question that will come up more and more soon is how much does this set up again for a stagflationary scenario? People are watching both sides of the mandate. Even Beth Hammack saying that is getting pretty tough. Let's take a look at some stocks moving at this hour, shall we? We are looking at Reddit. I think this is pretty interesting. Reported its most profitable quarter to date with a bullish forecast for revenue. Stock is soaring about 16%. You might remember when they went public, this was a stock people were watching very, very closely. Maybe not the Figma style pops anymore, but certainly retail names are interested in Reddit and Figma and ones like it, certainly ones that have recently gone public. Also interested in Fannie Mae. Really interesting story here. I know we're going to talk about it more this hour, Matt.
Yeah, absolutely. Fannie Mae climbing on news that President Trump asked CEOs to consider Fannie and Freddie CEOs to consider stock offerings, and this is clearly something that market participants have been betting on for quite a long time now.
We're watching Kimberly-Clark as well. They raised its full-year guidance after reporting its strongest sales volume growth in 5 years. It's up more than 6.6%. Looking at Exxon, also beating estimates as oil production cushioned the blow from lower crude prices. Chevron also raised its cash flow outlook. Listen, you can't see all of this love in the broader market, but some green on the screen under the surface.
Yeah, there are some movers to the upside. Exxon, not one of them, but I guess the drops being limited by that news, and Chevron up about 0.4%.
Now, coming up next, we're going to talk about Magnificent Seven earnings, mostly impressing Wall Street this week, but most of the Mag 7 in the red for the day. Not all for the week, though. We'll talk more about it next. This is Bloomberg Open Interest.
Let's get now to high interest and look at what's making headlines around the world. Bridgewater founder Ray Dalio has sold the remainder of his stake in the hedge fund, and left its board. The move ends a leadership transition that started more than a decade ago. Dalio's exit is a pivotal moment for the industry, given his influence. Credit strategists at Goldman Sachs are warning against complacency and are using their clients to hedge risks. Urging their clients to hedge risks, not using them to hedge risk. The warning comes after global spreads fell to the lowest level in 18 years. And this is why people are much more interested in treasuries now instead of corporate debt. Amazon is projecting a weaker than expected operating income and trailing the sales growth of its cloud rivals. The results leave investors searching for signs that the company's huge investments in artificial intelligence are paying off. And let's talk about that with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. Mandeep, I think Amazon said they expect about $20.5 billion at the top end of their range in operating profit this quarter. Is the street raising now its expectations for that since everybody else has done so well?
I mean, a lot of that upside in operating profit is coming from the core e-commerce business. The cloud side, AWS operating income actually was below consensus. And if you look at the CapEx spent for this quarter on AWS, it fell sequentially 20%. So yeah, even though the overall CapEx number has gone up, the AWS CapEx component was down. And so to my mind, clearly, they're not finding as much traction in terms of AI infrastructure as Microsoft and Google is, because at the end of the day, Microsoft has got OpenAI that's driving a lot of inferencing workloads. Google has got their own model. Amazon is sharing Anthropic with Google. And so that's why they're not finding as much compute on the AI infrastructure side. And probably that partly explains why the growth rates are lower than the other two cloud providers.
Right. If you look at the numbers, the difference is pretty stunning. If you look at it for AWS, it was a little over 17% of growth, whereas Azure was almost 40%. And so how do you explain that difference? Does it mean that moving forward, these two are going to look further and further apart?
Probably because they both give us a backlog number. In the case of Microsoft, the backlog is $368 billion. Not everything is Azure Cloud, but the bulk of it is. And in the case of Amazon, the backlog is for AWS is close to $196 billion. So, and we know the growth rates as well. Microsoft's backlog grew 38%. Amazon AWS was 25%. So all of them, all the indicators point to Microsoft and Google gaining share on the AI infrastructure side. Obviously, Amazon AWS is the biggest cloud provider, the traditional cloud computing provider. But there's no doubt, at least in terms of the numbers we are seeing now and the CapEx number that I alluded to earlier, that clearly Microsoft and Google are winning share in terms of AI infrastructure.
Mandeep Singh of Bloomberg Intelligence, we thank you so very much for rounding out this week with us. We are now going to shift gears to talk about Apple. They're erasing nearly all of their gains after posting its fastest revenue growth in more than 3 years, now down almost 0.5% in the early trade. Joining us now, Craig Moffett, founding partner and senior research analyst at MoffettNathanson. He is one of 3 analysts on Bloomberg with a sell rating for Apple. Now, the numbers themselves, did they stun you? Did they change your mind about anything about the trajectory of this business?
No, the numbers were, first of all, good morning and thanks for having me on. The numbers were very good. I don't think anybody would quibble with the growth rate for iPhones, 13%, services, 13%, both really strong numbers. The problem is the numbers don't really answer any of the longer term questions. And there's really nothing they could have reported in the very short term that's going to answer those longer term questions. Some of those are external. Those are, what we still don't know what's going to happen to tariffs, particularly with respect to China, but also even India and Vietnam are still cloudy. And we don't know what's going to happen with the revenues coming from Google that are subject to the antitrust case at Google that could impact as much as 20% of Apple's operating income, with potentially even a full stop. We don't know what's going to happen because of services or to services revenues because of the changes in the wake of the Epic Games ruling. And then finally, we still don't know the answer for AI. So those big questions are much more pressing than whether there was pull forward or not pull forward or that sort of thing with respect to iPhones in the current quarter.
What can Apple do, Craig, or what do you want to hear from Apple in terms of answers to those questions that you think is, realistic or possible within the next 6 months to a year?
Well, some of it's out of their control, right? I mean, there are a lot of questions about tariffs. And even if you knew the answer for tariffs of what is the number going to be, they gave guidance for just the current quarter, just like they did last quarter. They can give guidance 3 months out. And even that guidance was couched in the language of assuming that nothing really changes, which I think we've all seen is probably a bad assumption, right? So even they don't know what's going to happen to tariffs, and that's just one of the questions. But and again, they don't have any control over what's going to come out of Judge Meda's court in the Google case, so that is also out of their control. There's a lot of speculation and guessing about what they do about AI. Do they buy Perplexity, for example? Do they buy an answer? We may get an answer to that over the next 6 to 12 months, but even that's not going to tell us whether that really drives an upgrade cycle or drives a services cycle. And remember, we've been really cautious about the idea of an upgrade cycle based on AI over the last couple of months because it seems like Apple is transitioning more and more away from the idea of doing all of their AI agentic services, for example, on the device to much more of a mainstream solution that everybody else is pursuing of doing it in the cloud. If you do it in the cloud, say you buy Perplexity, you do something like that, that may actually be a perfectly good product, but then there's no longer any impetus for an upgrade cycle in iPhones because your current iPhone can go to the ChatGPT site or app and do anything you want in the cloud. And so you've got all of these questions about whether you're going to get an upgrade cycle, for example, that really aren't going to be answered in the short term. And our view is that the stock price, with a still close to 30 times earnings multiple, is demanding really rapid growth and an upgrade cycle that is just really hard to see at this point.
MoffettNathanson founding partner Craig Moffett. We've got to leave it there. We appreciate your time today. Of course, a big beat on the top line for Apple, but a lot of skepticism about the long-term trajectory there. And of course, a negative day, but in synchrony with the broader market. Let's go check on these markets, Matt, because it is really very much a down day. We are looking at earlier this week, 6,400 on the S&P 500. Yesterday, right. And now we are well below 6,300. We're actually at 62.41, 1.5% decline on the day. NASDAQ 100, 1.7% lower.
Coming up in the next hour, more coverage of those Mag 7 earnings with Needham analyst Laura Martin on Bloomberg Tech with Ed Ludlow and Caroline Hyde. She's a voice that the street listens to, so important to tune into that. This is Open Interest. Going to check on these markets. As Sonali said, yesterday we were above 6,400. Today we're down to 6,246. So a big drop after those jobs numbers missed and the revisions down were so drastic. That also causes yields to plummet. And you're looking at the 10-year right now at 423. The front of the curve falling even further. What is it, 20?
More than 24, about 24 basis points. Well, coming up, we're going to talk about the energy industry. Bring in Enbridge's CEO. Stick with us. This is Open Interest. Let's take a look at Canadian energy giant Enbridge. The company beating estimates in the second quarter while reaffirming its financial outlook. Enbridge also saying that the Trump tariffs should not have any material impact on its operations. With us now, Greg Ebel, Enbridge's president and CEO. Really interesting moment for the energy industry. And, to talk to you while we see days of hyperscalers saying that they're going to be spending more on CapEx. I know you've been working with with very prominent ones coming into this period. How do you see that impacting energy demand and the opportunity for you to secure more deals, similar like you had recently done with Meta?
Yeah, well, good to see you, Sonali. Look, it doesn't seem like this is slowing down in any way, shape, or form. And it's interesting. We're seeing that demand for power, as you say, from the Metas and the Amazons and the AT&Ts right across the spectrum. So, we announced a big deal on the renewable side with Meta this quarter, but in past quarters, we've announced it with others on the gas side. And it really is an all-of-the-above approach that they get. You're seeing a growth in electricity and power demand above the growth of GDP, which is unusual. In fact, usually it's about 2/3 of GDP, all driven, as you see, by data centers and AI. And fortunately, North America and the United States, in particular with these projects we're talking, has a great supply of natural gas, relatively cheap. So game on for energy infrastructure and a real competitive advantage for DC players and AI across the board.
Greg, I know that the tariffs aren't really affecting your business, and I'd love to hear why, because when I think of Canadian energy, I think of aluminum production. And obviously, the president has put a 50% tariff on that. Is that hurting demand for Canadian electricity, or do Americans just have to buy aluminum from Canada because there's nowhere else to get it?
Well, when I say it's not hurting our business, there's no doubt if your tariffs in play and it hurts industrials, maybe their demand goes down. But remember, we're the transporter of gas and oil and across the border. So, Canada moves about 4 million barrels of oil into the United States. And the systems are so integrated that on both sides of the border, the political leaders have realized, well, let's not touch that. So there are no tariffs on oil. There are no tariffs on gas as it moves across the border. And us as the largest shipper of that, therefore we don't have that impact. And in fact, the best market for oil and gas out of Canada really is the United States. And so that continues to be. Now, whether or not that starts to impact industrials and stuff, that's more, you're right, on the energy demand. But as Sonali just asked me about, that's being more than compensated on the power side for the need for power from data centers and AI and the general increase in power
But Greg,
overall.
how healthy is that ultimately? If you're saying that it's growing faster than GDP, it suggests that there's an economy that's not growing as strong as the data center economy, the AI economy is. So if you kind of had to pull out your crystal ball and say, okay, well, wait a minute, if we're so excited about all this investment in AI, if the real economy is not keeping up, then is that all really sustainable?
Yeah, well, I think it is. And here's why. As something that we've seen from technology over the years, right? We get more efficient on technology. It actually starts to use less and less powers per unit. So you can continue to grow the overall demand for power, but actually make that computing and the AI cheaper. So it's a bit of self-fulfilling situation here. So, GDP can still grow at a nice rate. All I'm saying is that power demand, because as we move to electrification, that's just going to grow at a faster rate. There's, even before data centers, there was a move to more electrification. We could debate whether that's a great idea, but if we move more and more to electrification, then you add on data centers, you're going to need that all above. You're going to need the renewables. You're going to need the gas. You're going to need oil. You're going to need everything. And since we ship all those things or produce all those things, that's a winner for companies like Enbridge. And I would argue, if the cost of that gets more and more efficient, that's a winner for the entire U.S. economy.
Yeah, I mean, even though electric vehicle sales have stumbled in the past couple of quarters, there's no debating the fact that that's the future of transportation, and they're going to need to be charged, all of them.
Yeah.
Greg, I want to know about regulations, because we've written story after story about how difficult it is to put up energy infrastructure in the United States. And I know that there's a lot of pressure to put up a new pipeline in Canada as well. How difficult are regulations, and how quickly has the Trump administration been able to deregulate here? What is Mark Carney doing there?
Well, that's an interesting juxtaposition there, Matt, right? So I think obviously a few more months in power for the president. They're moving extremely rapidly, and we see that directly in changes for the Army Corps of Engineers that engineers, which often approve many of our projects, changes at FERC to streamline, all in which to kind of move forward, as the president likes to say, energy dominance and industrialization in the United States. In Canada, we haven't yet seen the actions. We've heard the same type of political commentary, but the actions haven't happened yet, right? So we still have a very stunted permitting process here. There are still production caps on things like oil and gas through emissions. That hurts the need for infrastructure. And then if you want to do exports, which, exports of natural gas and oil out of the United States have grown phenomenally in the last 10 years. That's only just starting to happen here in the United States. So we'll see if Canada catches up. If they don't, the capital is going to move to the United States. If they do, I think you're going to have a very strong fortress North America, and that'll be positive for infrastructure players. But I would also argue that'll be positive for industrials and players around the world getting access to what is a great resource.
I am really curious about your presence in the U.S. for a moment here. That Meta deal that we were talking about was a solar contract in Texas. What can you tell us about future deals that could be just like it and the locations at which they might exist?
Yeah, so a very good point, Shana. There's no doubt the local permitting matters a lot. Texas is well known for having a nice permitting structure, but so too, I'd even say that middle of the continent, right? So you got the Ohios and Pennsylvanias. You've seen us build renewable projects there. Pipelines, as we know, tend to get built in those locations, and economic growth then goes to those. So you definitely have to look at the permitting. The other thing that's going to impact the renewable and solar type deals that we saw are that one big beautiful bill that was passed by U.S. legislators. And right now that looks pretty okay for the renewable players as well, as long as you're far along in terms of getting a hold of those tax incentives, which all of our projects are. I think the interesting question will be, as we hit the end of the decade and the next round of renewables may come forward, will there be tax incentives, or is the market going to have to adjust to that, which might mean increase in power prices, but we'll see how that all shakes out. If it's not renewables, there's plenty of natural gas in the country to be able to drive forward the power demand. So I would say the United States is in a bit of a catbird seat in terms of energy possibilities. Infrastructure growth looks pretty good for the next several years. And so other countries in North America are going to have to compete against that. And that means you got to giddy up on policy if you want to succeed.
All right, Greg, thanks so much for joining us. Greg Ebel there of Enbridge, walking us through a lot of fascinating aspects of the industry. Let's get to some single stock stories right now. Bloomberg stocks reporter Natalia Knežević joins us with the movers. Natalia?
Hi, Matt. Let's start with Figma. A lot of volatility in the stock. It's currently up by 10%, but earlier this morning it gained as much as 23%. On a two-day basis, we still see that the stock is up by almost 290%. Also, this trading gave Figma the largest first-day gain in about 3 decades for a U.S.-traded company, which raised more than $1 billion. It also made its CEO one of the world's richest people. To Bloomberg Intelligence, Figma's financials are strong. Growth is about 40%. Also, net dollar retention hovers around 130%. But the next big test for the company, of course, comes with Analyst's initiations and the next earnings report. Next stock I'm watching is Moderna. It's down by almost 9% today. We saw that second quarter sales were down by 41% on a year-over-year basis. Of course, it came amid slower sales of COVID-19 vaccines. But keep in mind that demand for vaccines is typically concentrated in the second half of this year. But Moderna also lowered its high end of its revenue forecast for this year. And of course, it attributed it to timing of contract revenue, which it shifted to the first quarter of 2026. And finally, Coinbase. The stock is down by 14%. Sales for the revenue for the second quarter was actually up on a year-over-year basis, but the number came below analysts' expectations. The company attributed it to a spot trading volumes globally and around the U.S. And also, average crypto market capitalization was approximately flat on a quarter-over-quarter basis. Bloomberg Intelligence says that Coinbase may actually see a better third quarter revenue going forward. But Sonali, to me, it's a really interesting report, especially considering we are watching some of the potentially big crypto IPOs.
Very interesting. Natalia Nizevich of Bloomberg News. I'm watching that Coinbase versus Robinhood dynamic. I'm also watching Fannie and Freddie because they're surging today on the news that President Trump asked top bankers across the country for pitches on monetizing the mortgage giants, including a major public stock offering that is being considered. Here with more, Bloomberg's finance reporter, Catherine Doherty. And we have actually seen some of this story play out before. In the last Trump term, you did see the conversation start to slowly take off. We didn't get there, but now it looks like it's much more serious.
Yes, you mentioned the top bankers at the U.S. banks.
The
These are the CEOs. These are the leaders of the biggest U.S. firms that we have here. So we saw them, and these meetings continue with Donald Trump. We do not know the specifics because that is exactly what Trump wants to hear from these leaders. He's bringing them in one by one, and he's essentially asking them to pitch the way that Fannie and Freddie might be monetized. So how that actually plays out is going to be the next big story that we're going to be paying attention to. But even the talks and the ideas that are shared within the White House is really the big story today. And moving ahead, it's going to be what does that look like in the future?
Yeah, I mean, what are the options? Because obviously the shares are trading, right? So it's not like an IPO.
That's right.
Is likely, since that would be initial public offering.
So only a portion of the shares are traded, and they're not fully monetized. So he is looking to hear from the banks that what can you do for Fannie and Freddie to do a bigger IPO where maybe it's full-fledged, maybe we're going to have other pieces of it. That's kind of the big question here. What does the structure look like? Because currently, the way that Fannie and Freddie is traded is not a full initial public offering.
Is there anything else that trades with what used to be implicit, but now an explicit government guarantee on their products?
I think that's kind of the big discussion here and the significance that you're pointing out. So I believe that these CEOs, they know what kind of a big deal this is, not just for the United States, but for their own firms too. Whichever firm is picked to lead based on the idea that they're presenting to the president is going to have huge ramifications for their future prospects in the investment banking industry.
Right. These types of deals don't come around all that much. It's kind of like the TARP era deals, right? It's like the prestige that comes with the listing and more than the actual listing itself. There's another story, too. Speaking of Mickey Bowman, who has been making a lot of news this week, but today in particular, this is starting the process of new risk-based capital rules that the banks could see. You are not really seeing the love being found within the banks today. Is it because the expectation here is that, yes, we'll be less strict than we initially planned, but still you'll see new rules?
I think that this is not an unexpected outcome. Everyone was expecting that the rules are not just going to go away. They're going to be lesser than this 9% that was not even fully digested, but presented under Michael Barr. So now if you have the future of Basel III Endgame going to look even less than 9%, again, it's not going away. It's just going to be diluted from what was previously talked about. And I believe that this has been priced in. This is not unexpected across the street. You've been hearing, and we've been reporting out, my colleague Katanga Johnson in D.C., he's been all over this story. And we really have telegraphed from day one, moving into the Trump administration, it's likely to look like a just watered down capital requirements for the banks. So it's really gung-ho for the industry. They're off and running, and it means that they will likely, after rules are finalized, and in this story, what is being reported out is that this proposal might not even come until the first quarter of 2026. So this is not something that happens overnight. We're still going to see this play out, but what it is expected, I think, is beyond there's nothing here that I think would cause concern.
It's not 19%, but it's also not 0%. So 9% is kind of the new normal here, Matt.
All right, fascinating stuff. Cato, thanks so much for joining us. Catherine Doherty there with a number of stories that Sonali just can't look away from. Let's get a quick check on markets here. You see a big drop in the S&P 500, 1.5%, and yesterday we were over 6,400. Today at 6,243, and really the yields are something that I can't look away from. I mean, 425 on the 10-year and a drop of, 24 basis points on the 2-year.
Just incredible, and the yields curve still steeper, so everyone's getting a little of what they want somewhere. Stick with us. This is Open Interest. And it's time for our Wall Street Week conversation. The race for satellite internet dominance is ramping up as low Earth orbit constellations like Starlink aim to transform global connectivity. David Weston explores the industry and whether there's room for competition.
Starlink has what looks like an overwhelming lead in LEO satellites, but it's not the only horse in the race. Jeff Bezos' Project Kuiper is trying at least to get on the track, though it's had to deal with manufacturing issues and launch delays earlier this year, currently leaving its constellation with fewer than 80 satellites in orbit, compared with Musk's 7,600 plus.
When you see someone like Amazon's Project Kuiper planning a second U.S.-centered started constellation that will occupy very much the same competitive niche as Starlink, it's really hard to see why that makes any sense and why there are any returns available to Amazon.
A Starlink competitor that's much further along than Kuiper comes from Europe. OneWeb launched its first operational LEO satellite the same year as Starlink. European satellite operator Eutelsat acquired OneWeb in 2023 and currently operates its own constellation of about 640 satellites. And OneWeb is pursuing a strategy that goes beyond LEO satellites alone.
We are the only satellite that has both the GEO and the LEO, and in fact quite a number of them because we have 35 in GEO and over 600 in LEO.
Jean-Hubert Lenat is the Chief Strategy and Resources Officer at Eutelsat. And it's not just the combination of GEO and LEO satellites that he thinks sets his company on a different path from Starlink. It's also the market they serve.
Starlink does address the consumer market, meaning that they do need much more capacity to actually serve all those customers. We are providing very basic but important connectivity to businesses, to government. What is very important to understand is we are not in the consumer market. We have right now just north of 5 billion in total globally of connectivity in B2B. And this is going to grow at least 3 times between now and basically 2033, where it should be close to 15 billion by that time. But more importantly, the LEO connectivity is really what is going to drive this market. So the LEO connectivity right now in B2B is only around 2 billion as we speak this year, expected to be there. Whereas we do expect it will be north of 10 billion, probably 11 or 12 billion by the same year of 2033, meaning that it will just be multiplied 5-fold for that period.
OneWeb, a subsidiary of Eutelsat, manages its constellation out of its London office.
I lead a team that has one main objective, which is uptime. So guaranteeing that our customers are actually always able to connect to the service that we provide wherever they are. And the role of the team here is actually to guarantee that the system works at the top performance and it delivers the high speed and the low latency that the constellation is supposed to provide.
And that was David Weston. You can catch Wall Street Week every Friday at 6 p.m. New York time. We're going to turn back to earnings because, of course, on Saturday we have Berkshire Hathaway reporting. Bloomberg Intelligence says the report is likely strong but uninspiring. For more, we are joined by Matthew Palazzola, Senior Industry Analyst for Bloomberg Intelligence. I'm actually a little less interested around the earnings themselves and more interested about the cash on hand, the potential for deal making, and all of the rhetoric around BNSF.
Yeah, so we have this deal with Union Pacific buying Norfolk Southern potentially. Our Rails analyst thinks that should that deal go through, which they're calling it an uphill battle, but should that deal go through, it would be detrimental to Burlington Northern. So that might force Buffett and Burlington Northern to act. I think it's highly unlikely they get in any sort of bidding war scenario. That's just not really a Buffett thing. The next logical target would be CSX, because that's an East Coast railroad as well, so it could connect the two. That stock has run up, so I feel like that probably makes Buffett a little nauseous to see the stock run up 20% instead of ahead of any kind of deal. But that's the current landscape there.
And we reported that CSX is working with Goldman to explore options, so getting the ground ready.
Yeah.
Maybe for potential conversations in the future.
How much money does Berkshire have, and what's a likely target?
So they have $348 billion of cash. So they could buy CSX kind of outright if they wanted to. A likely target, I don't know. They bought a mystery stock in the first quarter that was kept confidential on their 13F. I believe that's in the industrials area, and it's about $2 billion. So it's small potatoes for them, but that's probably the most recent thing that they've been working on.
How do you expect them to handle the cash hoard from here, just given how much they've been sitting on?
So Buffett had said, there was this theory maybe he was hoarding the cash for Greg Ebel to take over next year. He said, I'm not really doing that. It just wasn't a lot of opportunities for me. I kind of feel like at this point you've got only a couple of months left really of Buffett at the helm. Does Ebel maybe do a dividend or something in the future? I think that's a possibility.
All right, Matt, you have to work tomorrow.
Indeed.
We count on you to cover this for us. I'll be reading everything that you write. Matthew Palazzola runs our insurance coverage for Bloomberg Intelligence. Let's get a check on what's going on in the markets, because they're taking another leg lower, and I'm guessing rates continue to fall pretty substantially as well.
Yeah, check it out. And it's all across the curve. You're seeing the S&P 500. It's off of session lows for the day, but still down about 1.6%. You're seeing that really broad-based pain. Most major sectors are in the red. The bond market move was, of course, responding to that weak ISM, as well as more so the employment data. And so, of course, you would see that float through. Consumer discretionary is your worst sector on the day. Energy, financials, all doing worse off.
Yeah.
20 basis point move lower in the 2-year right now.
It's a pretty shocking miss on the jobs number, because we were looking for over 100,000. We got fewer than 75,000. Actually, I think 73 was the number. And the downward revisions brought us down to only 14,000 jobs added in the previous month. We actually revised jobs down by 258,000 over the past 2 months. And if you look at the 3-month run rate, we were adding 150,000 jobs on average. And now we're only adding 37,000 jobs on average over 3 months. If you take out the healthcare jobs, it's negative for this month, last month, and the month before. So very bad.
Very bad. And actually, to the point that you're making, they were bad numbers, but also bad backward numbers, which means things were worse than expected. So the bond market reacting pretty violently today.
All right, coming up on Monday, it's the weekend. Coming up on Monday, Citi's Stuart Kaiser and RBC's Lori Calvasina on the markets, plus Morgan Stanley's Tom Miles on global M&A. I'm really looking forward to that conversation. I'm guessing you booked that. And I'll see you back here today on the close. This is Open Interest.
Yeah.